Jake hits $1 million in his retirement account in 2030. So does Marcus. Same milestone, same year, same feeling, standing at the edge of a 30-year climb. They both book flights to celebrate. They both start drawing down at the same rate. And within 3 years, their financial situations look nothing alike. Because $1 million in 2030 isn't what $1 million was in 1995. And it isn't what the number on your statement actually means in your pocket. The number is real. The retirement it buys depends on 4 variables. Almost nobody checks before they stop working. Let's keep this fair. Jake is 65 in 2030. Marcus is 65 in 2030. Both spent roughly 32 years in the same industry, contributing steadily, watching their balances grow. Jake's million sits entirely in a traditional 401k. Marcus split his contributions, roughly 60% in a Roth 401k, 40% in a traditional. Same balance on the statement, completely different retirement. The difference doesn't show up on the account screen. It shows up every month when they open their bank apps and check what actually landed. Start with inflation. $1 million in 2030 buys significantly less than $1 million bought in 2000. The Bureau of Labor Statistics data and standard projections suggest cumulative inflation running at roughly 2.5 to 3% annually through this decade. At 3% compounding from 2000 to 2030, the purchasing power of $1 million shrinks to the equivalent of about $412,000 in $2,000. That's not an argument against saving $1 million. It's a warning about what you're actually working toward. Jake and Marcus both hit the same number. Neither of them adjusted for what that number actually buys when they get there. Here's the first thing most retirement calculators quietly skip: the 4% rule. Financial planners have used it for decades as a benchmark. Withdraw 4% of your portfolio annually, and you have a high statistical probability of not running out of money over a 30-year retirement. For a $1 million portfolio, that's $40,000 a year, before taxes, before health care. Before the inflation adjustment you have to make every single year just to keep pace with rising costs. $40,000 in gross annual income in 2030. That's the number most people are planning around without realizing it. Jake pulls $40,000 from his traditional 401k. The IRS treats every dollar as ordinary income. After the standard deduction, his taxable income sits around $27,000. Federal tax bill comes to roughly $3,000 a year. That leaves him about $37,000. Then he adds Social Security, let's say $22,000 annually. When he combines his traditional 401k distributions with his Social Security, the resulting income level causes the IRS to tax as much as 85% of his benefits. That's another $1,870 in federal taxes on top. His real take-home from a $1 million account plus Social Security lands somewhere around $57,000. Before state income tax, before Medicare premiums, before a single medical bill. Marcus pulls the same $40,000. His Roth portion, roughly $600,000, comes out completely tax-free. His traditional portion generates about $16,000 in withdrawals, still low enough that very little of his Social Security gets taxed. Federal bill is roughly $800. Same $22,000 in Social Security, almost none of it taxed. His take-home from the exact same milestone is closer to $61,000. Same account balance, same withdrawal rate, $4,000 more. Every year. Over a 25-year retirement, that gap is not small. Now here's what both of them missed: health care. This is where $1 million retirement math breaks down fastest heading into 2030. Medicare Part B premiums in 2024 are already around $174 a month per person. Projecting 5% annual growth, conservative for health care, puts premiums somewhere near $283 a month by 2030. That's over $3,400 a year before you fill a single prescription or schedule a single specialist visit. Dental coverage, vision, hearing aids, none of those are included in basic Medicare. A crown runs $1,200 to $2,500. Quality hearing aids can cost $4,000 to $6,000 per pair. Glasses with progressive lenses run $300 to $800. These aren't occasional expenses for people in their late 60s and 70s. They're predictable, recurring, and they add up fast. Most people retiring on $1 million don't budget separately for them. They just absorb them into the withdrawal calculation and watch the portfolio shrink faster than projected. And then there's IRMAA. If Jake's combined income from his distributions and Social Security crosses certain thresholds, his Medicare premiums get a surcharge that can add hundreds of dollars a month. It doesn't take an extraordinary income. One larger withdrawal pushes you over without warning. A diagnosis requiring expensive treatment. A home repair that forces a bigger than normal portfolio withdrawal. A family emergency. Any of those shifts the numbers instantly into IRMAA territory. The income threshold sounds high until you're actually hitting it. In 2030, a combined income over about $97,000 for a single filer starts triggering IRMAA surcharges. Jake's $40,000 withdrawal plus $22,000 in Social Security already puts him at $62,000. He's not insulated from that risk. Jake turns 73 in 2038. The IRS delivers a message he can't postpone. Required minimum distribution start. His portfolio has grown from $1 million to roughly $1.4 million over 8 years of moderate 5% growth, even accounting for withdrawals. His first RMD is calculated using the IRS Uniform Lifetime Table. At 73, the divisor is 26.5, forced withdrawal of about $52,800. Whether he wants it or not, he's already pulling $40,000 a year voluntarily. Now the IRS is stacking another $52,800 on top. His taxable income spikes. IRMAA kicks in. More of his Social Security gets taxed. He didn't earn more in retirement, he just ran out of time to plan around it. Marcus doesn't have the same problem on the Roth side. The Secure Act 2.0 eliminated required minimum distributions on Roth 401k contribution balances. His $600,000 Roth portion can stay invested, compounding tax-free for as long as he lives. His traditional $400,000 still generates RMDs, but the forced amount is proportionally smaller. Taxable income stays manageable. Medicare premiums stay at the base tier. Social Security benefits stay mostly intact. The box he checked 32 years ago quietly determined how much flexibility he has at 73. Here's the honest math nobody runs before they stop working. A $1 million portfolio sounds like enough. For some households, it genuinely is. For most people retiring in 2030, the real question is, what does that million generate in after-tax, after healthcare, after inflation income, and does that number cover the actual life they planned? Run it forward. $40,000 in annual withdrawals, 3% inflation adjustment applied every year. By year 10, you need to pull $53,700 annually just to maintain the same purchasing power you started with. By year 15, you're pulling $62,000. The portfolio is shrinking faster than the original projection suggested. The 4% rule assumes average market returns hold across the full period. It doesn't promise them. Sequence of returns risk is the variable that breaks $1 million retirements faster than almost anything else. If the market drops 25% in the first 2 years after you stop working, and it has happened more than once in the past 3 decades, and you're still withdrawing $40,000 annually, your portfolio doesn't recover the same way it would if you were still contributing. You're selling assets while prices are depressed. Every withdrawal locks in those losses permanently. A severe market drop in year 1 of retirement can shorten a 30-year portfolio by 5 to 8 years, sometimes more depending on the recovery timeline. The damage compounds because you can't pause your withdrawals and wait for recovery. Your living expenses don't pause. Your bills don't pause. The sequence of returns in the first 5 years of retirement matters more than the average return across the entire retirement. Someone retiring at 65 in a year the market drops 30% faces a completely different outcome than someone retiring in a bull market, even if they both experience identical returns across their full retirement span. Jake and Marcus both celebrated hitting $1 million. Neither of them stress-tested what the balance looks like if 2031 opens like 2008 did. The people who retire successfully on $1 million in 2030 have three things working for them. They know their actual after-tax monthly income based on their specific account mix, not the gross withdrawal number. They have a healthcare cost reserve built separately, typically $150,000 to $200,000, set aside specifically for medical expenses and not counted inside the main withdrawal strategy. And they have a documented plan for sequence risk, either a cash buffer covering 2 to 3 years of expenses or a fixed income allocation that lets them avoid selling equities into a declining market. The million is a foundation. What gets built on top of it in the 5 years leading up to retirement determines whether it lasts 20 years or 32. If you can't answer 3 specific questions right now, the number on your statement isn't ready to be called a retirement. What is your actual after-tax monthly income based on how your current accounts are structured, not gross, net? What does healthcare cost your household specifically, not the national average, your state, your prescriptions, your situation? And what happens to your withdrawal timeline if markets drop 30% in year 1? Most people know their balance. They don't know the number. Jake and Marcus both hit $1 million. Both filed the retirement paperwork. Both sat across from an advisor who showed them a Monte Carlo simulation with a 91% success rate and nodded through the presentation. Marcus asked what the 9% failure scenario looks like in practice and what triggers it. Jake looked at the 91% and scheduled his last day of work.